Hello traders, welcome back to the comprehensive course on options trading. Imagine you are driving a car on the highway and you keep a close eye on your speedometer to know exactly how fast you're going. Now, what if I told you that there is something just like that in the world of options trading? It is none other than our first option Greek called delta. And just like a speedometer, delta tells you how fast the value of your option is changing as the underlying asset price moves. So in this episode, I will break down what delta is, why is it crucial for options trading, and how you can use it to navigate the fast moving derivative markets. Having a strong understanding of option delta is very critical because it can help a trader understand how the change in the price of the underlying will influence the price of the option in terms of both direction and magnitude. And depending upon the value of delta, a trader can also assess the risk that is involved in an option trade. So, without further ado, let's get started. Take a look at these screenshots of Nifty spot price and the corresponding premiums of both call and put options of 25,000 strike over different times over the course of the day. It is clear that as and when the value of spot price changes, so does the option premium. More precisely, the call option premium increases with increase in the spot value and the put option premium decreases with the rise in the spot value and vice versa. From these screenshots, it is clear that the premiums will certainly change, but by how much will it change is the important question. This is exactly where the delta of option comes in handy. By definition, delta is the rate of change in the price of an option for every 1 point move in the price of the underlying asset. In other words, delta evaluates by how many points will the option premium change for every 1 point change in the underlying. So delta captures the effect of the directional movement of the market on the option premium, or it measures the directional risk of an option. The underlying asset under consideration could be anything from equity, index, currency, commodity, bonds, interest rates, etc. In the form of an equation, delta of an option can be calculated as the ratio of change in the price of an option to the change in the underlying price. Since an option derives its value from the underlying and any change in the underlying will be reflected in the option price, this also means that the change in the option premiums cannot be higher than the change in the underlying. And since it is a ratio, the delta value will fluctuate anywhere between 0 and 1. Just keep this in mind. As we have discussed many times, the value of a call option moves higher while that of a put option moves lower when the price of the underlying rises. Similarly, the value of a call option moves lower while that of a put option moves higher when the price of the underlying falls. In other words, the value of a call option and the underlying price are directionally proportional, while the value of a put option and the underlying price are inversely proportional. Because of this correlation with the underlying price, a call option will have a positive delta, while a put option will have a negative delta. The delta of a call option will fluctuate within the range of 0 and 1. Some traders even prefer to use the 0 to 100 scale. So a delta value of 0.5 on the 0 to 1 scale is equivalent to 50 on the 0 to 100 scale. Likewise, the delta of a put option will fluctuate within a range of -1 and 0 or between -100 and 0. So the delta value of -0.3 on the -1 to 0 scale is equivalent to -30 on the -100 to 0 scale. So similar to the speedometer of a car, where the speed is capped between 0 km per hour to some 220 kilometers per hour, delta values are also bound between 0 and 1 in case of call options and -1 and 0 in case of put options. Some beginners might even have a doubt in mind as to what exactly does this really mean. Well, let me clarify this using a simple example. Let us consider the case of a call option first. Let us assume that the current price of the underlying asset is 95 rupees. Let us also consider that a call option of 100 strike on this underlying is priced at 25 rupees and it has a delta of zero point 0.5. A few days down the lane, let us say the price of the underlying has risen to 115 rupees. Given that the price of the underlying has risen by 20 rupees and assuming all the other factors as constant, the value of the call option will go up by 10 rupees. That is, the price of the call option will now be worth 35 rupees. On the other hand, what if a few days down the line, the price of the underlying dropped to 85 rupees? In such a scenario, given that the price of the underlying has fallen by 10 rupees and assuming all else to be constant, the value of the call option will go down by 5 rupees. That is, the premium of the call option will now be worth 20 rupees. So as you can see from the example, the delta of an option helps to evaluate the premium value based on a directional move in the underlying. This is very useful information for traders. For instance, you are anticipating a massive up move of about 200 points in Bank Nifty, and based on this analysis, you decide to buy a call option. Before proceeding any further, keep in mind that the delta of the underlying is always 1. This is because if you buy 100 shares of a stock and the price of that stock goes up by 1 rupee, then you stand to profit 100 rupees. That is, for every 1 point move in the value of the underlying, the profit and loss potential is 100% of that 1 point move. Now, assume there are two call options and you need to decide which one to buy. The first call option has a delta of 0.05 and the second call option has a delta of 0.4. Now tell me which call option strike would you select and why? Now let's do the math and find out the better option. So you're expecting a 200 point move in Bank Nifty, which is actually the change in the underlying. Since the delta of the first call option is 0.05, the associated change in premium for this call option strike is 10 rupees. In case of the other call option strike, the delta is 0.4. Therefore, the associated change in this call option price is 80 rupees. So as you can observe, the 200 point move in the underlying asset has different effects on different options. In this particular scenario, a trader would be better off buying the call option strike with a delta of 0.4. And as we can see, the reward potential is higher for options with higher delta than those options with a lower delta. That being said, the risk potential is also higher for such options with higher delta than those options with a lower delta. This indirectly suggests that the delta can help a trader select the right option strike to trade. We will talk about this soon enough. But for the time being, let us find out why is the delta value for a call option bound between 0 and 1? And why can't the call options delta go beyond 0 or 1? For illustration purposes, let us assume two call option strikes, one with a delta value more than 1, say 1.5, and the other call option has a delta lesser than 0, say minus 0.4. We will assume the change in the underlying asset to be 100 points. Let us find the change in the call option premiums for both these strikes. For the first call strike, the change in premium turns out to be 150 rupees. Now, this answer suggests that for a 100-point change in the underlying, the value of call option premium is increasing by 150 points. In other words, the option is gaining more value than the underlying itself. This is not possible because an option is a derivative contract, as we have learned in our first episode, and it derives its value from its underlying asset. Therefore, it can never move more than the underlying. But in case if the delta is equal to 1, it tells us that the option is moving in line with the underlying. This is acceptable, but a value higher than 1 doesn't really make sense. This is the reason why delta of a call option is fixed to a maximum value of 1 or 100. Now, on a similar note, for the second call option strike with a delta of minus 0.4, the change in the option price comes out to be minus 40 points. What this suggests is that for a 100-point rise in the underlying, the value of call option premium is decreasing by 40 points. This is against what we have learned about the proportional behavior of the underlying and a call option. A call option will always move in line with the underlying asset. Therefore, the minimum value of call option delta is equal to 0, suggesting no change in the call option premiums for a change in the underlying. Anything below 0 doesn't really make any sense. This is the reason why the delta of a call option is fixed to a minimum value of 0. I hope things are making sense. Now let us consider the case of a put option. Let us assume that the current price of the underlying is 95 rupees. Let us also consider that the put option of 100 strike on this underlying is priced at 15 rupees and it has a delta of minus 0.5. A few days down the lane, let us say that the price of the underlying asset has dropped to 85 rupees. Given that the price of the underlying has dropped by 10 rupees, the value of the put option will go up by 5 rupees. That is, the price of the put option will now be worth 20 rupees. On the other hand, what if in a few days' time, the price of the underlying rose to 105 rupees? In this case, given that the price of the underlying has risen by 10 rupees, the value of the put option will go down by 5 rupees. That is, the price of the put option will now be worth 10 rupees. By now, you know why the delta of a put option ranges between minus 1 and 0. It is simply because of the inversely proportional relation between the underlying and the put option. You can also gauge the reasons why delta of a put option strike cannot go above 0 and fall below minus 1. You can extend the case of the call options to understand why the maximum delta value of put is 0 and the minimum value is minus 1. To make things simpler, let me present a few more examples in a tabular format. You can notice that as the underlying price goes up by 1 rupees, the value of a call option increases by the amount of delta, while that of a put option decreases by the amount of delta. On the other hand, as the underlying price goes down by 1 rupee, the value of a put option increases by the amount of delta, while that of a call option decreases by the amount of delta. In fact, assuming everything else to be constant, we can set a formula to calculate the new option price, which is shown here in the screen. So the new option price is the total sum of the old option price and the product of delta and the difference between the new and old underlying price. So if the new underlying price is 110 rupees, the old underlying price is 100 rupees, the old call option premium is 10 rupees, and the call delta is 0.6, then the new option price would be 16 rupees. On the other hand, if the new underlying price is 110 rupees, the old underlying price is 100 rupees, the old put option price is 10 rupees, and the put option delta is minus 0.6, then the new put option price would be 4 rupees. Similarly, if the new underlying price is 90 rupees, old underlying price is 100 rupees, the old call option premium is 10 rupees, and the call delta is 0.4, then the new option premium would be 6 rupees. On the other hand, if the new underlying price is 90 rupees, old underlying price is 100 rupees, and the old put option premium is 10 rupees, and the put delta is minus 0.4, then the new option price would be 14 rupees. So in this equation, keep in mind the sign of delta. That is, delta is positive for call option and negative for put option. Now that we have understood how to calculate the new option price for a given change in the underlying price and at a given delta, it is time to dig deeper towards understanding the concept of delta. So far in this video, I have defined delta as the rate of change in the price of an option for every 1 point move in the price of the underlying asset. In reality, there is another way of looking at delta, that is by using the moneyness of options. Using this concept, delta can be considered as the probability of an option expiring in the money. For instance, a delta of 0.5 means that there is a 50% probability of a call option expiring in the money. A delta of 0.8 means that there is an 80% probability of a call option expiring in the money, and so on and so forth. Similarly, a delta of minus 0.6 means that there is a 60% probability of a put option expiring in the money. A delta of minus 0.1 means there is only a 10% probability of put option expiring in the money, so on and so forth. Now, some of you may have this doubt. Who actually decides the value of delta? We have already talked about this at the start of this episode. The value of delta is one of the many outputs from the Black-Scholes-Merton option pricing formula. The formula takes in a bunch of inputs and give out a few key outputs. This outputs includes the options delta value and some other Greeks. Now, based on the moneyness of options, the delta values obtained from the formula varies. So here's a table which will help you identify the approximate delta value for a given option. Using this table as reference, we can plot a chart between delta and spot price for both call and put options. This is how the chart will look like. The chart, which is marked in green, is for call options, while the one plotted in red is for put options. One thing is pretty clear from the table as well as the chart. I will help you understand this using an example. But before that, as we have seen in one of the previous episodes, an option could be in any one of the three states. It could be in the money or ITM, at the money or ATM, or out of the money or OTM. Now just a recap, a call option is in the money if the strike price of the call is less than the spot price. It is ATM if the strike price of call is equal to the spot price, and it is OTM if the strike price of call is greater than that of the spot price. Similarly, a put option is in the money if the strike price of the put is greater than the spot price. It is ATM if the strike price of the put is equal to the spot price, and it is OTM if the strike price of the put is less than that of the spot price. Now, assume Nifty spot price is at 25,020 and the strike under consideration is 25,100 and the option type is a European call option. Now tell me, what is the approximate delta value for the 25,100 CE when the spot price is at 25,020? From the table, it can be said that the delta value should be between 0.45 and 0.3 as 25,100 CE is slightly out of the money. For the time being, let us assume the delta is 0.4. Now assume that the Nifty underlying moves from 25,020 to 25,120. Now what do you think will be the delta value? Since prices increased, 25,100 CE will now be an at the money strike. Therefore, the delta should be around 0.45 and 0.55. Let us say the delta is 0.5. Now once again, assume the Nifty spot price moves from 25,120 to 25,200. What do you think the delta value will be now? Since 25,100 CE is now a slightly in the money strike, the delta should be between 0.6 and 1. Let us assume it to be 0.7. Now finally, let us assume the Nifty underlying gets beaten down heavily and it drops to 25,000 from 25,200. What do you think will happen to the delta value of the call option? With a fall in spot prices, the 25,100 call option will once again become an out of the money strike from ATM. Hence, the value of the delta will also fall from 0.7 to somewhere between 0.45 and 0.3. Now, did you observe anything interesting? It is just that as and when the spot value changes, the moneyness of an option changes and therefore the delta also changes. It is pretty clear that the delta changes with the changes in the value of the underlying. Hence, delta is a variable and not really a fixed entity like we have used in the calculations at the beginning of this episode. Therefore, if an option has a delta of 0.3, it doesn't mean this value will remain throughout. Instead, this delta is likely to change with a change in the value of the underlying. You can say the same for put option delta also. So what conclusion can we arrive at? It can be said that the state of the option moneyness has an impact on the value of both call delta and put delta. A call option that is in the money will have a delta that is greater than 0.5 A call option that is at the money or almost at the money will have a delta that is equal to or very close to zero point 0.5, while a call option that is out of the money will have a delta that is less than zero point 0.5. Similarly, a put option that is in the money will have a delta that is less than minus zero point 0.5. A put option that is at the money or almost at the money will have a delta that is equal to or very close to minus zero point 0.5, while a put option that is out of the money will have a delta greater than minus zero point 0.5. In addition to this, the deeper the option is in the money, the closer the delta would be either towards 1 in case of a call option or towards minus 1 in case of a put option. Meanwhile, the deeper the option is out of the money, the closer the delta would be towards 0 for both the options. So this is what you can infer from the table as well as the chart. We can also make another inference. That is, when an option moves from out of the money to at the money to in the money, the absolute value of delta also increases, which increases the premiums, which in turn increases the reward as well as the risk potential. Here, I will show you two scenarios. I have considered three call and put option strikes with absolute delta values of 0.8, 0.5 and 0.2. In the first case, the underlying asset makes an up move and then falls lower. For this case, we will only consider the call strikes. And as you can notice, the call strike with the highest delta value of 0.8 is much more responsive to the changes in the price of the underlying. It moved very similarly to the underlying. On the other hand, notice that the call option that has a delta of 0.2 was the least responsive to changes in the price of the underlying. Neither did this option rise much during the up move in the price of the underlying, nor did it fall much during the down move in the price of the underlying. The call option with the delta of 0.5 started slowly, but it gradually gained pace before declining again. Now look at the second case where the underlying was on a down move and after a point it reversed higher. For this case, we will consider only put strikes. And as you can notice, the put option that has a delta of minus 0.8 is much more responsive to changes in the price of the underlying. It moved almost similar to the underlying. On the other hand, notice that the put option that has a delta of minus 0.2 was the least responsive to changes in the price of the underlying. Neither did this option rise much during the down move in the price of the underlying, nor did it fall much during the up move in the price of the underlying. And finally, the put strike with the delta of minus 0.5 started slowly, but gradually it gained pace before declining again. So, as a rule, we can say that options that have a higher delta are more responsive to changes in price of the underlying than those options that have a lower delta. This is where I would like to introduce a new concept associated with delta. You might have witnessed some crazy hero or zero trades where some traders would buy out of the money or sometimes even deep out of the money options, and depending upon the underlying's performance, the trader either stands to make a killing generating mind-blowing returns, or on the opposite, he might lose all the premium paid. Stories like this are very common in the world of options. Just take a look at this screenshot of Bajaj Finserv call option with expiry on 29th August 2024. Just look at the 1740 and 1760 call option strikes. You'll be shocked to see 739% and 618% returns over the course of a single day. Now just go to the top gainers or top losers list, select any stock from the futures segment and take a look at its option chain. You'll be shocked to see the returns. You won't see these kind of numbers in any other instrument, especially over an intraday period. This is one of the motivating reasons why a lot of people trade options. But why do people take these risky trades and why do they select the OTM and deep OTM strikes? Now, there can be different reasons. The number one reason is that OTM and deep OTM options are generally cheaper, so you only need to deploy less capital. The second reason is that since the premium paid is lower, the amount which is risked is considerably lower, even though you stand to lose the entire capital amount. On the flip side, the potential return that is available for the taking is limitless. But this does not answer the real reason why these crazy trades happen. In fact, most traders don't realize, or maybe they don't care much about it. The answer to this lies hidden in this chart. Frankly speaking, it is due to the magic of delta acceleration. In this graph, there are four delta stages mentioned. Let us look into each one of them. This is the delta acceleration graph, whose y-axis is the delta value from 0 to 1 for call options or 0 to -1 for put options. The x-axis represents the moneyness of options for a change in the spot price of the underlying. Either way, the concept is the same for both type of options contract, so we will discuss it primarily based on call options. So there are four stages mentioned in the graph, starting from pre-development to takeoff to acceleration and finally the stabilization stage. Before we move ahead with the discussion, let me give you an example for making this easier. Think of this curve or graph as the different stages of a flight. Let me explain. At first, the aeroplane engine is turned on and it is on one side of the runway preparing for a takeoff. But as of now, there is no visible movement. This is similar to the pre-development phase of Delta. Up next, the plane starts to move, increasing its speed, or we can say the plane is gradually accelerating against a headwind. This is similar to the second phase of a delta curve, where the delta tends to take off, or in simple terms, the delta values start to accelerate gradually. Soon the aircraft's acceleration increases so much that the headwind lifts the plane up, and this is where the aeroplane accelerates the most in order to counter the air resistance. This analogy can be used to represent the third stage of the delta curve, where the delta values accelerates to the maximum and moves so quickly. Just keep this acceleration term in the back of your mind, as it signifies another Greek named gamma, which we will talk about in the next episode. And finally, after reaching the desired altitude, the plane will stabilize and cruise at a particular speed. Analogous to this, the final stage of delta acceleration curve is the stabilization stage, where the delta gets capped at the highest constant value. You can think of this the other way around also, analogous to when a plane prepares to perform a landing. But in that case, instead of the flight accelerating, it is actually decelerating. Likewise, the delta will also decelerate and gets capped down to the lowest value. Now, let's revisit the four stages once again. But as a side note, the delta of an option changes with other factors other than the spot price itself. We will talk about these factors later in this video. But for the sake of simplicity of calculations, we will consider that the delta of a particular strike is not impacted by any of these factors, and we will even assume that the delta won't change with a change in the spot price also. So, the first stage is pre-development. This is the stage when the option is out of the money or deep out of the money. The delta value here is 0 or close to 0. The delta value will remain close to 0 even when the option moves from deep OTM to OTM. And as you can see from this nifty option chain, the deep out of the money strikes from 26,650 to 25,650 will have a delta value lower than 0.1. Now let's assume the spot price of Nifty is trading at 25,000. The current premium for 25,500 CE strike is approximately 10 rupees and the delta is 0.05. So even if the Nifty underlying moves higher by 100 points, the strike price is likely to move only by 5 points. Hence, the new premium will be 15 rupees. Though this may look like a very small change on an absolute scale, when you think of it in terms of percentage, then the 25,500 call option has increased by 50%. So what is the conclusion that we can derive from this observation? Even though deep out of the money options tend to give an impressive percentage returns, but for this to happen, the spot price has to move up by a very large value. So I would ask you to kindly avoid buying deep out of the money options, because first of all, the deltas are really small or the speed of premium change is negligible. And secondly, the underlying has to move significantly in one direction in order for the option to work in your favor. The second and third phases are takeoff and acceleration. These are the stages when an option transitions from out of the money to at the money. This is where the maximum potential for making money lies, and therefore the maximum risk too. Let me explain. Let us assume the Nifty spot price is at 25,000 and the call option strike under consideration is 25,200 CE, which is a slightly out of the money option whose delta is 0.25 and the premium is 40 rupees. So when the spot price moves 100 points from 25,000 to 25,100, what do you think will happen to the 25,200 call option premium? Since delta is 0.25 and the change in underlying is 100 points, the change in premium is 25 points and therefore the new premium will turn out to be 65 rupees. And that, my friend, is almost a 62.5% return. Isn't it clear that for the same 100 points of the underlying, the slightly out of the money option behaves very differently from deep out of the money options? Also keep in mind, here we have assumed the delta to remain constant for a change in the spot price. But in reality, the call option delta would increase with an increase in the underlying value. That is, the delta of 25,200 call option could rise from 0.25 to maybe 0.35 or more. This will in turn result in an increase in the strike price premium. Now, coming back to our discussion, what have you learned from these observations? It is clear that the slightly out of the money option, which usually has a delta values ranging between 0.2 or 0.3, is much more sensitive to price changes in the underlying. As we have seen, for a 100-point change in the underlying, the percentage change in the slightly OTM options is quite enormous. This is exactly how option traders make multifold returns by buying slightly OTM options when they expect big moves in the underlying. Let us take this forward and see how an ATM option, that is 25,000 call option, which has a delta of around 0.5, would react to the same 100-point change in the underlying price. The premium of 25,000 call option is 120 rupees. Then for 100 rupees change in the spot price, the option premium is expected to move 50 rupees. So the new option premium will be 170 rupees, which is a decent return of almost 42%. As mentioned earlier, in real market conditions, the change in premium would be higher as we can expect the delta to be in the slightly ITM range of 0.6. Now we have one more stage to consider, and the final stage is stabilization. This is when an option transitions from at the money or slightly in the money to deep in the money option, and the delta start to cap and stabilize at the maximum value of 1 for call options and -1 for put options. It is quite evident from the graph that the delta will start to flatten out when it reaches the maximum value of 1. This means the option delta gets fixed to 1 and the delta value would not change any further. Let us understand how this works. Consider the Nifty spot price to be 25,000 and consider two call option strikes, namely 24,900 and 24,500. 24,900 is a slight in the money option having a delta of 0.65 and a premium of 180 rupees, while 24,500 call option has a delta of 0.95 or assume it to be 1 and it has a premium of 500 rupees. If the underlying changes by 100 points, then how do you think the two options will behave? The change in the premium for 24,900 call option will be 65 points. So the new premium will be equal to 245 rupees, which is almost a 36% rise. In the case of 24,500 call option, the premium change will be 95 points. So the new premium will be equal to 595 rupees, which is actually just a 19% rise in the premiums. When we observe closely, we can infer that in terms of absolute change in the number of points, the deep ITM options win over the slightly ITM options. However, in terms of a percentage change, it is the other way around. Clearly, the ITM and deep ITM options are much more responsive to the changes in the underlying, but they are certainly most expensive. So, one of the key takeaways from this graph is that delta values are capped after a particular limit. This means that, irrespective of how much the spot price falls, and even if the call option goes from OTM to deep OTM, the option's delta will cap and remain close to zero. Similarly, even when the delta moves beyond ITM to say deep ITM, the delta value does not change or it stabilizes and stays at the maximum value of 1. You can notice similar characteristics for put options delta as well. So try to avoid trading on deep ITM and deep OTM options. And I will tell you why. We all know that an option contract has a finite lifespan after which it ceases to exist. We call this expiry. In episode 7, I have briefly told you that as time passes, the time value component or the extrinsic value of the option price will decay. I have also mentioned that during the initial life of an option contract, the pace of time decay will be slow. However, as the time to expiration reduces, the pace of the time decay will start accelerating. During the final stages of an option contract, the pace of the time decay will be very fast. Considering this fact, the odds are actually stacked against the option buyer in making a profitable trade. Remember, if the underlying price does not move much, the buyer of an option can lose the money because the intrinsic value of the option price will erode and the option would actually expire worthless. In addition to all this, options that are in the money will be more expensive than those options that are at the money, which in turn will be more expensive than options that are out of the money. We have also seen that options that are in the money will have a higher delta than those options that are at the money, which in turn will have a higher delta than those options that are out of the money. Often, people who are new to options trading will be tempted to buy options that are deep out of the money just because they are very cheap. While there is nothing wrong in doing this, you must keep in mind that the odds of deep out of the money options gaining in value are very low because of the time value component and because they have a lower delta. This in turn suggests that the deep out of the money options are not particularly sensitive to underlying price changes, so the absolute premium change will be negligible. Now, when it comes to deep in the money options, they are extremely expensive and most of the time illiquid. But since they have a high delta, they are most sensitive to changes in the underlying. We could think of buying deep ITM options instead of future contracts for the same underlying for a much lower price. For example, one lot of Nifty futures cost roughly around 80,000 rupees, while one lot of deep ITM options cost anywhere from 20,000 and above. So it's relatively cheap. But the downside is that options are decaying instruments, unlike futures, so the extrinsic value will decrease over time, even if the option stays in the money upon expiry. And most importantly, deep in the money options are illiquid, so there might be big bid-ask slippages which can affect the trader's performance. This is quite evident in these two charts. You can notice that the deep OTM options did not change much despite the noticeable change in the price of the underlying asset, while the deep ITM options moved almost similar to the spot price, but they were affected by time decay. The other important point is that when you expect big price moves in the underlying, then buying slightly out of the money options makes sense, given the fact that delta acceleration really comes into action during the takeoff and acceleration phase. During big price moves in the underlying, the slightly OTM options tend to move quickly between the stages of ATM to slightly ITM, giving you massive returns. So it is not just about selecting the right type of option, but also about choosing the right strike price and the right delta levels when entering an option trade. Buying an out of the money option just because it is cheap and without taking into consideration other parameters is a sure shot way of losing your capital. You should buy a deep out of money option only when there is a greater time to expiration and when you have a view that the underlying asset will rise swiftly in case of a call option to benefit or fall swiftly in case of a put option for the price of that option to gain in value. Always keep in mind that deep OTM options are cheap for a reason. They have a delta whose absolute value is less than 0.3, meaning they have less than 30% chance of expiring in the money. So the deeper the option is out of the money, the lower will be its delta, meaning the lower will be the probability of that option moving in the money by the expiration date. I hope it is clear. Now, let's talk about an interesting application of delta. The thing is, you can use the delta to gauge the probability of an option contract to expire in the money. When you buy an option, irrespective of call or put, what outcome do you want? Clearly, you want the market to move beyond the strike price so that the option transforms from an OTM option to ITM option. As an option trader, you can use the delta to figure out the probability of the option to transition from OTM to ITM. For example, a slightly OTM option might have a delta of 0.4. In order to figure out the probability of the option transitioning from OTM to ITM, simply convert the delta value to a percentage number. So when converted to percentage terms, the delta of 0.4 is 40%. Hence, we can say that there is a 40% chance for the option to transition into an ITM option. Similarly, we can go to the option chain and estimate this probability by yourself. Some of the deep out of the money strikes may have a delta of 0.1, suggesting only 10% probability, while some deep ITM strikes might have delta values of 0.95, which suggest a 95% probability for the option to transition into in the money. So, if you have listened to all what we have discussed, you would be shocked as to how important a factor delta is when it comes to the world of options. I know this is a lot to take in all at once, so take notes, watch multiple times to make sure that you have a decent understanding of the concept. Our central aim is to improve our odds in options trading and be in that top 10% traders who are actually making money by trading derivatives. With that motivation in mind, let's keep going. We will now talk about certain other factors which has an impact on the delta of an option. So far, we have mostly talked about the impact of underlying price and option moneyness on option delta. Now let us talk about another key factor that impacts delta, which is the time left to expiration. Let me first highlight the relationship between delta and time to expiration. For in the money options, the deltas of options that are closer to expiry are higher than the deltas of options that are farther from expiries. And why is this? This is because there are greater odds of ITM options expiring in the money when there is little time left to expiration than when there is more time left to expiration. On the other hand, for options that are out of the money, the effect is opposite. That is, the deltas of options that are closer to expiry are lower than the deltas of options that are further away from expiry. This is because there are lower chances of OTM options expiring in the money when there is little time left to expiration than when there is more time left to expiration. Let us now understand the significance of this concept using an example each for both OTM and ITM call and puts. For each of these examples, assume that Nifty underlying was trading at around 25,000 in the spot market. We will also consider their expiration dates. These are the current week, next week, and current month expiries with a difference of 7 days between these expiries, and also assuming that all these days are active trading days. Today is Wednesday and current week expiry is happening tomorrow, which is Thursday. Now let's start with that ITM call option. You tell me, what are the odds of an ITM Nifty call option having a strike price of say 24,500 expiring in the money by say the end of the current week expiry? The option chain would say about 95% probability. Now tell me, what are the odds of this same 24,500 ITM call option expiring in the money by say the end of the next week expiry? Just with a change in expiry, the probability would decline to 85%. Do you notice the difference? If you consider the odds of the ITM call option expiring in the money by the end of the current week expiry, you would further see a decline in the probability to 80% or lower. So it is clear that as there is less time left to expiration, the odds that an ITM call option would expire in the money will be higher. However, when the time left to expiration is high, the probability that an ITM call option would expire in the money reduces, and on a relative basis, it tends to move closer to 0.5 or 50%. The next example is for a OTM call option. Once again, what are the odds of an OTM Nifty call option having a strike price of say 25,500 expiring in the money by say the end of the current week expiry? The option chain would say about 5%. However, the odds of this OTM call option expiring in the money by say the end of the next week expiry would be 20%. Likewise, the odds of this OTM call option expiring in the money by the end of the current month expiry would be around 35%. Notice the difference. As there is less time to expiration, the odds that an OTM call option will expire in the money will be lower. However, as the time to expiration is higher, the probability that an OTM call option will expire in the money increases, and on a relative basis, it tends to move closer towards 0.5 or 50%. In a similar manner, we can talk about put options. For an ITM put option, as there is less time left until expiration, the odds that an ITM put option will expire in the money will be higher. However, as the time left to expiration is high, the probability that an ITM put option will expire in the money reduces, and on a relative basis, it tends to move closer to minus 0.5 or 50%. Likewise, for an OTM put option, as there is less time left to expiration, the odds that an OTM put option will expire in the money will be lower. However, as the time left to expiration is high, the probability that an OTM put option will expire in the money increases, and on a relative basis, it tends to move closer towards minus 0.5 or 50%. I will present all this in a table for easy reference. Please do note that whether the option is a call or a put doesn't matter in this scenario. We will talk more about how time impacts option price when we will take up the theta topic. Now let's discuss the impact that volatility has on delta of an option. I will be quick with this one as the video is already very long. Volatility, in simple terms, is a measure of how much the price of an asset goes up and down over time. If the price changes a lot in a short period, it is considered highly volatile, meaning it is riskier and less predictable. On the other hand, if the price stays relatively stable, it is considered less volatile. This is the basic idea of volatility. Now, for ITM options, the delta will be higher if the underlying has a low volatility, and the delta will be lower if the underlying has a high volatility. This is because the probability of an ITM option expiring in the money is higher when the volatility is low, as low volatility means less likelihood of a big move in the price of the underlying. However, when the volatility is high, the probability that an ITM option would expire in the money reduces, as a high volatility could increase the likelihood of a big price move in the underlying, causing the delta to reduce. Similarly, for OTM options, the delta will be lower if the underlying has low volatility, and the delta will be higher if the underlying has high volatility. Again, this is because the probability of an OTM option expiring in the money is lower when the volatility is low. However, when volatility is high, the probability that an OTM option would expire in the money increases, causing the delta to increase too. You can use this table for future reference. Here also, it doesn't matter whether the option is a call or a put option. I thought about ending this video right here, but then I would not be doing justice if I skip a very important property of delta that could come in handy when dealing with multiple option contracts and complex option strategies. I'm talking about the additive nature of deltas. The simple idea is to add up the deltas. The only guideline to follow here is giving the proper sign. A call option delta is given a positive sign while a put option delta is given a negative sign. Long positions are given a positive sign while short positions are given a negative sign. This means a long call option position will have a positive delta while a short call option position will have a negative delta. This is very important to remember. This indicates that the value of the call seller's position decreases as the underlying asset price increases. On a similar note, a long put option position will have a negative delta while a short put option position will have a positive delta. Therefore, we can safely say that even delta works in the opposite manner for an option holder and an option writer, irrespective of a call or a put option. Another point to keep in mind is to multiply this delta value with the lot size if you have multiple positions open. This will give you an idea about how much your option position will move for 1 point rise or fall in the underlying. This is better understood using examples. So let us take a few cases. In the first case, you are long three different call options with delta 0.7, 0.5 and 0.1. So there is an ITM, ATM and deep OTM strike. Since you are long the position, just add all the deltas and it turns out to be 1.3. This means the combined positions have a positive delta of 1.3. This also means that both the underlying and the combined option position moves in the same direction. So for every 1 point change in the underlying, the combined option position changes by 1.3 points. So if the underlying moves by 100 points, the combined position is expected to move by 130 points. Consider another case where you are long on a combination of call and put strikes. Adding all the deltas following the guidelines, the combined position has a positive delta of 0.3. So if the underlying moves by 100 points, the combined position is expected to move only by 30 points. Yet another case is when you are both long and short on either call or put options or both. Just follow the guidelines and take the sum. In this example, a trader is long on both call and put options. The combined position has a negative delta of 0.8. This means the underlying and the combined option position moves in the opposite direction. So if the underlying moves by 100 points, the combined position is expected to move by 80 points in the opposite direction. You can even have different quantities as well. For instance, you can short 2 lots of put options and go long on 3 lots of call options with different deltas. The permutations and combinations are limitless. Take a look at this scenario where a trader is long on a call and put with delta of 0.3 and minus 0.3. In this case, the combined position has a delta of 0. This implies that the combined position does not get impacted by any change in the underlying. For example, if Nifty moves by 100 points, the change in options position will be 0. Such positions, which have a combined delta of 0, are called delta neutral positions. Delta neutral positions do not get impacted by any directional change in the underlying. They behave as if they are completely insulated from the market movements. However, delta neutral positions react to other variables like volatility and time. We will talk about this at a later stage in this course. Anyways, I would like to wind up this video by reminding you again that delta is not a fixed entity like we have considered for doing some calculations, but rather it is a dynamic entity. In other words, the value of delta keeps changing with changes in other variables that are inputted in the option pricing model. These include the spot price, volatility, time to expiration, interest rates, and dividend, if any. If the value of any of these variables changes, so will the value of delta. It is important to understand changes in delta because this change in delta will have a significant impact on the success of an option trade. As the underlying price changes, the option can move from OTM to ATM and then to ITM. Similarly, an option can also move from ITM to ATM and then to OTM. As this change happens, the value of delta will also change. For instance, when an option is out of the money, the delta will be less than 0.5. But if the underlying price changes, because of which this option moves in the money, its delta will be now more than 0.5. Given that the option is now in the money, it will be more responsive to changes in the underlying price. So it is very important to be aware of such changes. As the option price moves further in the money, the delta will keep increasing, causing the option price to be more and more sensitive to changes in the underlying price. And as the option price move further out of the money, the delta will keep decreasing, causing the option price to be less and less sensitive to changes in the underlying price. Let me consider an example to show you the impact of delta on options. Assume that a call option is in the money and it has a delta of 0.5 and the option price is 15 rupees. Let us say that in a few days, the price of the underlying declined by 10 rupees, causing this option to move out of the money. Due to this, assume that the delta has now declined to 0.4 and the option price has dropped to 8 rupees. Let us now assume that in a few days' time, the price of the underlying has rose by 10 rupees, thereby rising back to its old price. However, given the lower delta and the impact of time decay, the option price has risen just to 11 rupees. So, have you noticed the difference? Even though the underlying price fell and later recovered back to its old price, the option price, on the other hand, has not recovered to its old price. One reason for this is the change in delta or the dynamic nature of delta, which has made the option less sensitive to the change in the underlying price. Hence, whenever you are planning to create new positions in options, or more importantly, you have already created one, it is very crucial to pay a close attention to what the option delta is doing. So, this is all you need to know about delta up until this point. Yet we have not yet learned how to gauge or predict the variation in delta due to different factors. So in the next episode, I will talk about another option Greek, which is used to measure the rate of change of delta so as to get an idea of how to calculate the new delta whenever the price of the underlying changes. I hope this video was informative and useful. And if this series of videos are helping you get better in trading, then kindly consider supporting our efforts by liking and sharing this video. Help this video reach more people. Also drop in comments regarding any doubts or queries that you have. And if you are new to the channel or you have not yet subscribed, please make sure to subscribe and also enable the bell notification to stay updated on our new future videos. I will see you guys in the next episode. Till then, bye.